Let me tell you about two people. Person A has been investing for 3 years. They've been disciplined, consistent, putting money away every single month. They checked their portfolio, and it's grown by about $8,000 this year from their contributions alone. Person B hasn't touched their portfolio in years. They just left it alone. And this year, their account grew by $31,000. Same market, same returns, completely different results. Here's the wild part. Person B didn't earn more money, didn't get a better job, didn't make smarter trades. They just had more money sitting there already. And that right there is the secret that almost nobody talks about. There is a specific number, a threshold, where investing stops feeling like work and starts feeling like magic. And that number is $250,000. Most people think about investing the wrong way. They think it's all about how much you put in, so they obsess over saving an extra $200 a month, cutting subscriptions, skipping vacations, grinding to squeeze more into their portfolio every single month. And look, that discipline matters. That effort is real. But here's what nobody prepares you for. For the first several years, you are doing most of the heavy lifting. You're the engine. Your contributions are what's moving the needle. The market is helping, sure, but the growth you see, that's mostly your money going in. Then something shifts, quietly, slowly, and then all at once. At some point, your money starts making more money than you are putting in. And once that happens, the whole game changes. Psychologically, mathematically, in every way that matters. That point, for most people investing in a diversified portfolio at average market returns, tends to arrive around the $250,000 mark. Let's break this down simply. The market, historically, has returned around 10% per year on average. After inflation, call it 7%. Now, let's say you're investing $1,000 a month, which is already more than most people manage, so you're doing well. In year one, with $10,000 invested, a 10% return gives you $1,000 from the market. You contributed $12,000 yourself. The market's contribution? Barely noticeable. Now, fast forward. You stayed consistent. You've got $100,000 invested. That same 10% return gives you $10,000 from the market. You contributed $12,000. Getting closer, but you're the one driving growth. Now you hit $250,000. 10% on $250,000 is $25,000. You contributed $12,000 that year. The market gave you more than double that, without you doing anything extra. You could have gone on vacation, you could have had a bad month. Didn't matter. The money was working harder than you were. This is what people mean when they talk about passive income in its truest form. Not a side hustle, not a rental property, just your money silently compounding, starting to outrun your own effort. Here's the psychological part that makes this so interesting. There's a concept in behavioral economics called the effort-reward disconnect. Our brains are wired to expect results to match effort. We work hard, we get rewarded. We slack off, we don't. That's how everything in life works, until investing. Because in investing, the less you feel like you're doing, the more it often works in your favor. And that disconnect messes with people. In the early stages, when your portfolio is small, you feel like it's not working. You're putting money in and barely seeing growth. So people give up. They pull money out. They try to time the market, chase trends, look for shortcuts. They can't feel the compounding yet, so they assume it isn't happening. But here's the cruel irony. The people who quit are usually just months or years away from the moment where compounding kicks in for real. It's like filling a bathtub with a slow trickle. For a long time, almost nothing seems to be happening. Then suddenly, the tub is half full, and it fills up faster and faster.